All right, I don't know how we make this panel session debatey and lively, given it's the last session for the day, but I'm sure we'll make it interesting, even if we're covering what's been defined so far as the boring topic, generating high yield. So just as a start, I'll just get three of you to give it, I know you've all spoken today, but just give a quick high-level introduction again to yourself, just a sort of 1 to 2 liner, and then we'll go into the questions from there. Starting with you, Francis.
Me to start?
Starting with Francis. Starting to get a bit lively. I'm Francis MacDonald. I'm with Capstone Funds. We are a real estate debt fund specialising in short-term flexible finance in residential property primarily.
Hi, I'm Emmanuel. I'm CEO and co-founder of Sucasa. We're a fintech focused on accelerating home ownership for young Australians.
Stephen Goakes, Managing Director of Natgen Group, reformed lawyer, grandfather, and commentator on yield matters.
Who decided you were a reformed lawyer? Just kidding. Okay, so Francis is a starting point. So, like, obviously the area of non-bank lending has increased a lot. So just, it'd be great to give some understanding as far as how you got into the space yourself, and then also what you saw as a problem, in the area that you're actually targeting. What did you see? What do you observe? And how do you actually see the market right now?
Sure. So private debt, or private credit as it's otherwise known, EY recently called it having a golden moment. And McKinsey have just released saying that last year, globally, it was the fastest fundraising and the best performing alternative asset. So there's no doubt that private credit is absolutely having its moment as an asset class. And that's the reason really we got into it. So Capstone Funds is actually a family-run fund between myself and my husband. We both have strategy, finance, transactions, infrastructure, investment banking backgrounds. And we're always very active in our own investment portfolio. About 6 years ago, 2017, 2018, we started to get into non-bank lending ourselves. And we just were so attracted to that risk-return proposition that it enabled us. And we saw this incredible pipeline of opportunity. Non-bank lending has been growing 15% per annum over the last 5 years, according to the RBA. And compared to the USA or compared to Europe, we're actually a margin market share of what those global players are. So there's a lot of growth in Australia. Lot of ways to go for private credit in Australia. So we saw that opportunity and we wanted to get on top of it. And
brilliant. So seven years ago you saw it, and Mario, you're obviously a new entrant to this, but you've done a lot very, very quickly. What I found interesting when I first spoke to you was that you've raised money from different VC investors, but then also you got this fund-related business as well. So the question I suppose to kick off for you is how is and then also you mentioned that you work for a sort of prominent family office in Australia. So there you are with a nice, safe job inside of a family office, amongst some of the wealthy people. You think, do you know what? What I might do is I might get into the startup area and build a startup and take a different approach to it. So go through that journey for yourself and what you saw.
Yeah, I still don't really think or necessarily believe that I'm in the non-bank lending space. We really came at this from a problem perspective, and I think naturally this business is where we sort of ended up. So exactly to your point, I had no intention of starting a non-bank lender. I was probably the best job I've ever had, frankly. I was sort of investing globally in tech companies and real estate, and I think the opportunity for us was really there is a big enough problem and a attractive enough capital markets niche that we can make a dent in this country. And so that's really how I came to it, which is, and that kind of speaks to my view on non-bank lending generally, which is that there needs to be either the regulatory space created by, to sort of exclude banks from entering that market, or the lack of will from banks to enter that market that then gives non-banks the air cover to really attack a space. And that's exactly what we have. Commercial real estate, as Francis mentioned, is growing really quickly for similar reasons. We're in a really attractive niche because banks can't do it. It's very expensive for them to do it. And so we step in, we offer a better product, and that's how we go.
Brilliant. I like how you said you don't think you're in the non-bank lending, but I think it's literally written on your website. Just saying.
Yeah. Well, it's there's still hope for us to become a bank or something in the future. Who knows?
Just kidding. And Stephen, back in 1994, that's going to be the most memorable slide for me for the phone. No, so for you, like you're the company's obviously being a part of this sort of journey and watching this space unfold. Like I suppose what's been one of your most interesting observations over the years, and I suppose what in your company's history, as far as how many more investors are participating, I suppose the desire for, to access sort of high yield opportunities, and especially how have you seen the changes now that we're in a high interest rate environment?
In terms of the more it changes, the more it stays the same to some extent. I mean, investors still need the same things they've always need. They need opportunities to get yield and to get growth and to balance those things correctly. As a net user of debt over the years, there's certainly been a big difference in how banks fund things. They've got harder to deal with, I think it's fair to say. And I'm actually a great cheerleader for non-bank lenders' growth because they've given options that banks were just simply moving out of. And as Francis said, the opportunity was clear. And it's terrific that people like these guys are moving into that. But generally speaking, I think yield there are a lot of investors out there who are looking for yield, particularly people who are relying on their investments to produce income for themselves. And I don't think that's really changed much at all, to be honest.
And for you, Francis, you've obviously got a short-term, mortgage perspective. What unique, advantages does that give to you in your sort of own strategy, given it's typically a short-term profile for your investments?
Sure. So our strategy primarily is to deliver outsized returns relative to the risk that is underlying. And by specialising in short-term finance, it allows us to target loans that are short tenor but higher interest rate. And that allows us to therefore return to our investors double-digit returns while still actually having similar LVRs to traditional banks.
And how do you typically source the opportunities, or do they find you?
They just find us. No, we have an extensive network of brokers routinely that we work with. We probably see 10 times the deals that we're able to do. But then as we've matured, certainly we see that a lot of our borrowers are actually repeat borrowers, which is fantastic. We become a trusted partner and then we just do deals again and again together.
Brilliant. And for you, Mario, non-bank lending platforms like Sucasa have gained popularity, obviously, for offering sort of high yields. What are some of the key strategies that you employ from a management of risk perspective? Like, you were very good at detailing your profile as far as who you're sort of targeting. What are some other things you're sort of looking at from the risk management perspective?
Yeah. So, I mean, consumer lending is sort of naturally designed to be extremely scalable, and so that really comes back to sort of a high level of clarity about what you're trying to do, and then the discipline to do only that. And so we have a very sort of specifically defined credit box, which is we focus on very high quality collateral in deep liquid markets. So that's Australian metro capital cities. We don't do high density or high-rise buildings, only low-rise and low-density buildings, and then combining that with a very clear credit box on borrower quality, and so that's sort of similar rate buffers to the banks, actually higher rate buffers than most banks these days, and so it really is in the consumer space less about picking, which is not what we do. We create a policy and a framework that we need to then apply at scale in a very disciplined way, and constantly checking that against where the market sits is how we sort of manage that going forward.
Thanks, Mario. And for you, Stephen, what are some of the key factors that your team sort of looks at when analysing and assessing opportunities?
Again, we're quite big on process. I think discipline's a very good word for that. So making sure that we're acquiring assets for our investors that are fulfil the requirements of our investment philosophy. And I think from an investor's perspective, I would suggest whether you're looking at property funds such as ours or investing in mortgage funds or non-bank lenders, look for that process. Make sure that they're properly licensed. Ask some of the tougher questions, and the answer shouldn't be. The answer should be clear and quick and easy to give. Good lenders have a lot of risk management built into them, and a reason for doing a loan isn't just that somebody came and asked for it. You have to, and I'm not suggesting any of you guys do that, but I'm just saying you've got to make sure that your loans fall within your loan mandate, and I'm sure you do, but not everyone in the industry does. Not everyone in the industry does, and you have to be careful as an investor in those sort of funds.
And for you, Francis, you mentioned that for every sort of 10 opportunities that you see, you guys would maybe sort of potentially, lend to one. What are the sort of criteria that you're looking for assets which you sort of lend to?
So firstly, we're asset-backed lending compared to consumer lending. So number one to us is understanding the quality and liquidity of the asset that we're lending to. So whenever we go through our due diligence and credit processes, we look to understand the value of the property, the market depth and liquidity in which we're operating, a detailed review of the borrower, their ability to service. We often also get personal guarantees, group guarantees in addition. And importantly for us, since we do short-term finance, is the exit, because we're not doing 3-year style loans. We are doing short loans, which means the exit of the loan is very important so we don't end up in a default scenario. Outside of that, we have very defined investment criteria about where we will lend to, what we will lend to, and the diversification requirements in our funds. And that should give investors a lot of confidence around what are you actually getting into and what can we do.
Thank you. And for you, Mario, I'm going to go back to your sort of the initial investment in the company, right? So you raised 7 million, is that correct? Yep, and you had leading Why were VCs backing you? What was it that you were doing on the technology front that they were backing you?
Yeah, one clarification, because we do mortgages, so we're both asset-backed consumer finance. So
Not a dig.
Yeah. No. But just to clarify, so we're obviously we have collateral as well. Just to clarify for anyone, but whether we're writing personal loans. So yeah, we've raised money from a couple of US VCs. I guess the reason why they've invested in us is. This is one of the unique markets in Australia where the local Australian market is a global venture scale market. There's, something like 125,000 low deposit home loans written in Australia annually. We save customers something like, $5,000 to $10,000 while still making sort of pretty excellent returns on our loans. And so, the market opportunity is large enough to invest here. And then I think the other thing was that we've sort of observed Australian VCs have been a little bit once bitten, twice shy on lending as a category. And so we saw a lot of conservatism from them, which we didn't see from US VCs on that front as well. And just an eagerness to solve the problem. I think the problem space is large enough and meaningful enough and enough a part of the zeitgeist that even an American sort of opening the AFR can see that home ownership in Australia seems to be a bit of a problem. Yeah.
And Stephen, like for you, like obviously there's going to be a new range of sort of, I suppose in this growth, I've seen it, there's a lot of new players sort of entering the market. What would you say to investors that are sort of looking to make their sort of first investments into, whether it be funds like yourselves, funds like Francis, funds like Mario? What advice would you give them entering this space? What should they understand about the sort of risk-reward ratio? How should they be doing their due diligence, etc.?
So they're sophisticated investors, so we don't choose to give them advice on what sort of risk premiums
That's
they
the
should
lawyer
be looking
answer.
for. But one thing I do get asked quite a lot by new potential investors is how should I assess you? And my advice is, don't ask the person who you're assessing how to assess them. Ask someone else. But the answer is always to those people. Look to what regulation they've gone through. Make sure they're properly licensed. It's pretty hard to hide on the internet. Google everyone. Really, just the usual things. We always tell people to go and talk to their trusted advisor, whoever that's going to be. Mostly those people don't really know how to do the due diligence either. Read the information memoranda carefully and ask whatever pertinent questions come out of that.
Brilliant. And just for I suppose my final question, and I suppose this really affects everyone and it's right across the board, and there's macro factors at play which have sort of created this interest in it. But from what you're seeing from a political perspective, from the way the markets are playing, interest rates, politics, what are the factors that and this is for all three of you to answer, by the way, what are the factors that you worry most about, that you think most about, that you've got your eye on? What sources of news are you looking at, etc.? I'll start with you, Francis.
The property market, of course. Looking at property market every day. Regions by and what the forecasts are saying. As everyone would know, and it's a source of the problem, is that the Australian property market's been really resilient for investors. So I feel a bit double-edged in that it means that it's a very stable basis for our fund, but from a society perspective, it's something I do really worry about for home ownership. So I'm really glad to see what you're doing, Mario, because I worry about that for the next generations. Interest rates, of course, we track periodically. Interestingly, we've found that our returns have been relatively inelastic to the ongoing cash rate because we do short-term finance, and our borrowers are more incentivised by speed to market and meeting their bespoke arrangements rather than the rate, which is really interesting. And then what else keeps me up at night? I think tracking interest rates, the property market, and our competitors, of course. What else is offering a market? I think private credit has absolutely been booming, as I said before, but that also means a lot of funds and a lot of opportunity is coming on board for investors. So I think a really important thing for us is that we always remain competitive and in the market and providing the best product to our investors.
Brilliant. And you, Mario?
It's slightly different. I think for us, again, it comes back to we're actually writing very long tenor loans, and the idea is that our underwriting should be robust through the cycle. We rate, like I said, we rate test people at 300 basis points over the current swap, so over the current rate. So if we're writing a home loan at 6, we're testing that they can repay it at 9, and similarly, so our whole focus is that that we don't need to be changing our policy at any given point in time, that we can be robust through the cycle. And so the focus is again on sort of discipline, and that's really, I should say, it's a really data-driven approach. So, you can, Australia's mortgage history isn't as long as the US, but, using either countries, going back, you can see the resilience in again, sort of highly liquid collateral. So probably should say two things. For someone to default on a consumer mortgage, two things need to happen. They need to both not be able to pay, and the asset value needs to reduce below their equity value, right? So if both of those two things don't happen together, then they can efficiently exit the mortgage. They can sell the property, or they just keep paying until their equity value is up and they're happy to keep a hold of it. So we focus on high quality borrowers that are close to the core of the economy. 70% of our borrowers are sort of either software engineers, professionals, or otherwise sort of, on the revenue generating side of their business. And the rest of them are sort of similarly highly skilled nurses, teachers, government workers, people with sticky employment. So that's kind of built into our underwriting process. And then the other is highly liquid, high quality collateral. So you've got, large amount of new Australians coming in. Can you keep underwriting them? Can they keep those liquid markets buoyant? That's sort of the two ways we think about it.
Thanks, Mario. And you, Steve?
What do I worry about? Well, after the dot-com boom, the dot-com bust, the millennium bug, SARS, the run-up in the markets after that up to 2007, the global financial crisis, the drop after that, the credit squeeze, the run-up in the markets after that, the global
Europe debt
financial
crisis. Don't forget that one.
debt crisis, the global financial crisis, and everything that's happened since then. Not much, because I agree with what
You forgot COVID. How did you forget that one?
Sorry, COVID.
And then
Of
the
course,
cost of living crisis.
We'll find some others too, but not much. What keeps me up at night? Principally my bladder.
So, okay, so nothing's stressing you out too much, but what do you see as the biggest sort of growth areas? Like you guys invest, is it mostly in Queensland or across a few different states?
Queensland, New South Wales and WA at the moment. So just...
Give the investors some insights in where you think the real growth is to be had.
well, I like, as I said in my presentation, I like those three areas of regional convenience retailing, value-added industrial, and non-capital CBD office. Population growth is just a wonderful thing for property over time, and so long as you're buying assets that have reasonable alternate use, then I think time heals most ups and downs in property, as it does in
Bitcoin.
in most existing assets. So I'm happy.
I just knew you were never going to mention Bitcoin, so I threw it in. And for
Yeah,
you, Francis,
yeah.
you're focused on the Australian. Mostly around Sydney.
No, we lend mainly around Brisbane, Sydney, and Melbourne.
Okay,
We're certainly
got that
seeing
completely
that
wrong.
Brisbane is one of the biggest growth markets at the moment, and WA, but we're currently not in WA. So we see a lot of our loans at the moment are up in Queensland.
Okay, and for you, Mario, any sort of growth areas where I suppose your approach sort of doesn't sort of yield to that, but any sort of growth? I know you're very targeted on your actual strategy. Was there any sort of segments which you think, okay, this is likely to outperform?
Look, not really. Like, our three big markets are young people, young families and family formation, and then divorcees who are sort of then, like reforming families. So, our whole thematic is that it's human to form families and that we need to help people get into houses because that's a core part of how they do that.
Brilliant. Helping people get into houses and then helping them make more babies. Good stuff. All right, ladies and gentlemen, we are going to finish there. We're only down to 2 minutes left, but just want to give the opportunity to say thank you very much to the panelists for joining. I really appreciate having them participate today. As I said, this has been a new area for us really over the last 18 months, and it's going to be something that we want to provide a lot more focus on because I said it really comes from you guys in that, the feedback that we get from how active you are in participating in these types of opportunities means that we want to make sure you get the opportunity to connect directly. So feel free to have a chat with the speakers and panelists. That is us for today. Thank you so much for coming along to Private Capital 2024. Thank you again to the Australian Securities Exchange for hosting us. It's been a big day. It's been an incredible day, and I appreciate everyone. And thank you again for your keynote at the end of the day, Victoria. Have a great afternoon, everyone.